You see, that is very nicely written, the amount here, right? So if you still have the question, please do let me know, we can discuss. If no more question, let's just move forward. So now we have completed the double declining method as well. So the straight line method is best for those assets who generate revenue evenly over time, who generate smooth revenue over the time. Unit of production method is best for those whose wear and tear is based on the usage. For example, plant, machinery, vehicles. The more you run, the more you have to pay maintenance costs. It's like that. And basically, straight line method is used for buildings, right? Because they are used smoothly. Double declining methods are best for those assets who generate revenue early in their useful life. For example, technology related plant and machinery. For example, mobile phone production plant, because every year new model is coming and old technology is going to be obsolete. So for all those new technology related plant machinery, so they normally, the managers or accountant, they charge those plant assets as double declining depreciation method. Okay, because every year new technology come and they become more obsolete rapidly, so they wanna charge maximum depreciation or double declining method to those technological advancement equipments. So this here is the comparison. So did you notice something, that the overall depreciation is the same, right? So if you add all the depreciation, it is the same for 5 years. The thing is that only how you allocate during the year, it changes. So it means overall 5-year profit, if you add it, it is the same, but per year profit is going to be increase or decrease. So you see how much in year 1, the double declining method gives you the lowest profit, right? In year 2, the unit of production method is going to give you lowest profit. In year 3, lowest profit is going to be from unit of production method. See, so in early years, or early stage of the acquisition of the asset, the double declining method gives you highest profit, because double declining method is giving you lowest profit because it's giving you highest depreciation at early years. So this is the, if you want to see through the graph, so you see it is rapidly decline, it is straight line, and it is according to the usage of the units on our asset. That's it. So many companies, they are using, 88% of the world company, they are using straight line method. 7% are using double declining method. So other name of double declining is accelerated depreciation method. Double declining method or accelerated depreciation method is the same. 4% of the companies are using unit of production, and 1% are using some other methods which we are not covering here today. So we have illustration here. So I want you to pause the video and do it by yourself, and then compare the answer. So you see we have given the data here, the van. So they purchase it for 13,000, right? 1,000 is book value. So straight line method, at the end of the year, you see, because you are applying the straight line method, it is giving you the straight, smooth annual depreciation method. In this method, the end year value would be the salvage value or residual value. So this is the accumulated depreciation. So the benefit of applying the straight line method is that the revenue or the profit would be smoothed out. Not the revenue, the profit going to be smoothed out due to the smoothing of the or normalizing of the annual expenses, right? This is the accounting and finance terminology, normalizing or smoothing out, right? You see here, so everything is like, it's giving you the same expenses, 2400, 2400, 2400. This is another unit of production method in which you just find out the per mile depreciation and you multiply it according to the numbers. So mile drivens multiplied by per unit rate. Per unit rate is 30,000 minus 1,000 divided by the total useful life in miles. So per unit is 0.12. So you just multiply it. That's it. So that is the answer here. I'm just going to show you the answer. So that's it. And if you apply the double declining method here, so remember the two differences. Double declining method is 2 multiplied by 1 over n, or the double percentage of straight line method. And straight line in double declining method, you use the cost. It means not 1200 to 12,000 you multiplying with the depreciation percentage, you are multiplying it with 13,000. So you see here, 13,000 multiplied by 40%, here we go. Right, and at the end of the year, no, the book value must be equal to 1,000, right? And if you multiply 40% of 1685, it would be a bigger number. Sorry, it would be a lesser number, 674, and if you less it, it would be 685. So you just pick that number here. You don't write just 674 because at the end of the 5-year, it must be equal to the salvage value or residual value, right? So that's why here. So now other issues in accounting. What if we want to increase the life? What we say that the truck gonna live for 5 years. After 3 years, you overhaul the engine, and now its useful life will increase to 3 more years. So then how you are going to account for? Plus, does depreciation affect the taxes? Of course, yes. If we apply higher depreciation, it means profit will be lower and lower tax is going to be paid to the government, right? Of course, it affects the income tax as well. What if you sold into the market, you said that the residual value is 1,000. If you sell your vehicle into the market, it is sold for $500 rather than 1,000. It does affect our depreciation cost. What if it is more than 1,000? Right? Entries are going to be made. Yes, we are going to make that. So there is a benefit of having double declining method. Like I told you, early year, highest depreciation, lowest profit, lowest taxes, right? So it means, remember, cash flow is different than the profit, right? Because depreciation is non-cash. So we can use that cash flow, which is saved from applying the lowest taxes, we can reinvest into the business. That's it. We call this tax shield, 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 that we make a shield against taxes, and we use those cash flows to reinvest in our business. But overall, 5-year taxes going to be the same, but the segregation of the taxes is going to be different during the year. So look at that. If you pay higher taxes in early year, so your hefty cash is gone to the government in early years. So you could have used those cash in the business and generate more profits. So it's better to use double declining method, so that you have to pay less taxes. So the cash flow, you have generated tons of cash flows, you can reinvest into the business and generate more savings and more revenue before you actually pay the total taxes to the government. So for tax purpose, so this is straight line and accelerated depreciation. You see here, if you are using depreciation method for straight line, so you see here, the cash flow analysis and accelerated analysis is going to give you $2,520 saving for just using accelerated depreciation method. So this is not basically not the agenda of this chapter. Just for your knowledge, that's it. If you don't understand this, then just don't worry about that. Our agenda is to learn the depreciation method and the entries. That's it. So depreciation for the partial year, and we will be, after covering this topic, we will be stopping our discussion here, and rest of the stuff we will be doing in our next class. So just we are going to basis our discussion for this depreciation for the partial year. So let's just talk about this. So if we want to calculate the depreciation for partial year, so let's see the illustration here. Suppose UPS purchases a warehouse building on April 1st at 500,000. So remember, depreciation we find out for the whole year, 12 months. So we purchase this building on April 1. It means April, May, June, July, August, September, October, November, December. It means the building we are going to use is only for 9 months till 31st of December. So what will be the depreciation? If its useful life is 20 years and 800,000 is residual value. So remember, this 21,000 is for whole year, but we bought this building on April 1st. So April 1st to December 31st, how many months we use this building, and our financial year closes on December 31st. So we must multiply it with 9 by 12. So we will record this depreciation as 15,750. Like I told you, we can also find out monthly, quarterly, this kind of things as well. So we call this depreciation for partial years. Okay, so we are basing or closing our discussion here. We will be starting our discussion next class discussion from what if we change the life of the asset, if we increase its lifespan of the asset by overhauling, then how we would be calculating the depreciation. So all these issues plus the depreciation for intangible assets and other assets going to be, we will be discussing in our next class. So our today's agenda, we finished what is depreciation, what is the cost, how we calculate the cost, plus how we calculate the depreciation under 3 methods, and what if we want to find out the depreciation for partial years, like 9 months, 6 months, how we are going to do that. So rest of the chapter we will be finishing in our next class. So any question? If no more question, then we are going to end our discussion here. Okay, class. So till the next class, take care, and please revise this slides and the chapter until the next class. For the next class, we don't have any assignment, and we will be continuing this chapter. Okay?
Take care.
Take care. Stay safe.
Right. Thank you, sir. Goodbye.
Bye-bye.
Thank you.